Welcome, Leith, to our second podcast, and one that I will put up on my website this week, Land Cycle Investor, because what we had through the week was what we had expected and what we'd spoken about in the last edition of this that we did, which was the RBA pushing rates up, and that has occurred. That means that everybody now is accepting that we're probably in a rate hiking cycle. It's the end of rate cuts. That's going to have implications for the property market more so than anything else. So yeah, what was your take on that? I mean, it was expected for you as well, right?
Yeah, absolutely. I think, look, and I think the financial markets had like a 70% chance, or there's even above 70% chance that we're going to get a rate hike this week. So, yeah, look, I think it was a fait accompli after the previous week's inflation data came in stronger than, well above what the Reserve Bank's target is. So they got a target of keeping inflation between 2 and 3%, and the true mean inflation, which is the one they look at, it's also called underlying inflation. That was running at 3.3% annually. So that's obviously 0.3 above the top of their target. And it's also strengthened in the last 6 months. So in the last, it went up, I think it was 0.9% over the quarter, which if you annualize that, that's 3.6% annual run rate. So yeah, and not just that, obviously. So the RBA's got two key performance indicators. So it's obviously price stability to keep the inflation between their target, but it's also to maintain full employment without pushing up interest rates. And the unemployment rate the previous week before that, so I think 2 weeks ago, fell to a 7-month low of 4.1%. And that was also lower than the RBA's expectations. So as a result, it was almost certain, but there's always an outside chance that they might wait a month or whatever, just gather some more data or whatever. But yeah, it was very obvious they were going to hike it. But what got me the most about it was actually the statement of monetary policy. So when the RBA makes a decision, they release a statement of monetary policy, which is basically it's a pretty big document, and it outlines their thinking on the economy and the global economy and all sorts of areas, the housing market, drivers of inflation, all that kind of thing. But right on the back of that report, which is like page 50 or something, they outline their table of all the economic assumptions. And what struck me about it, and I've actually got a extract of it on the slides, is the Reserve Bank actually put an assumption in there, and this is sort of based on market pricing. So it's not saying what they're going to do, but they put an assumption that the cash rate's going to rise 2 more times.
Yeah.
So it's going to rise to, we're going to have 2 more rate hikes, 2 more 0.25 rate hikes. And even with those 0.22 more rate hikes, the RBA's forecasts for the trim mean inflation, which again is the one they look at, to rise further in the period ahead. And it won't fall to the mid-range of their target, which is 2.5%, until after June 2028. So that's shown in the table on the top left there. And so as a result, the Reserve Bank thinks that inflation is going to be higher for longer, and interest rates obviously are going to be higher for longer as well. And we're probably going to get 2 more rate hikes. So not a great story. And there was a few other little tidbits in there which are interesting. So the Reserve Bank's actually upgraded its unemployment forecast.
Mhm.
So it now expects unemployment to rise over the forward estimates. That's the chart in the middle there from Alex Joyner. And the unemployment rate, they were previously expecting a peak of 4.4%. Now they're tipping 4.6%. So what that basically tells you is they think that in order to get inflation back down, unemployment needs to go up, and needs to go up by 0.5%. And finally, the bottom right corner chart is on real wages. Now, this is interesting because we've obviously had the biggest decline in real wages. That's the wages after inflation in modern history. So they fell by about 7.5% from the peak, or nearly 8%. And we've rebounded about 1% of that in real terms, but so not a lot. But the Reserve Bank, over its forward estimates, thinks that the real wage is going to fall in the near term, and they're actually, by the end of 2028, real wages are going to be tracking exactly what they are at today, and they're going to be tracking at about March 2011 levels, and still 6.4% below their mid 2020 peak. Now, admittedly, that peak, as you can see in that chart, was during the COVID when they were handing out job JobKeeper and all that sort of stuff. So it was a bit artificial. But even so, by the end of by mid 2028, our wages are still expected to be about 6.5% below their peak, tracking at the same level as where they were in March 2011. And if you, I didn't even bother to do it because you can sort of do it yourself. But if you were to extrapolate that real wage chart, we wouldn't get back to the peak level until about the 2040s, given the run rate that's implied here. But obviously that's just that doesn't mean a whole lot. So yeah, not a great picture, and it's especially bad picture if you're a recent first home buyer who suck it in on the Albanese government's 5% deposit scheme. Because when you think about it, according to industry estimates, about 20,000 first home buyers have jumped into the market into the 5% deposit scheme since the 1st of October last year. And given that they've only taken out a 5% deposit, they would have extended themselves because, by definition, if you're only putting 5% down, you've got a very high loan to value ratio. For most of them, it'd be a very high share of their income, their mortgage payments. And when you think about it, if we get another 2 more rate hikes, so on the top of the one we've just gotten, mortgage rates would go up by about 0.75%. Now, on an average new mortgage, so the average new mortgage in Australia is $700,000 according to the ABS. If we get the 3 rate hikes, that implies a $330 per month increase in mortgage repayments. So I think if you're a first home buyer who got suckered in, you stretch yourself, borrowed to your limit to purchase a home using the 5% deposit scheme, you could be into a pretty nasty time. And the worst case scenario for them is obviously if house prices then fall, because you could see a situation where if we get a New Zealand or a Canada style correction or whatever, a lot of first home buyers who purchase with a 5% deposit will then be in negative equity. And it's also particularly nasty because if the RBA's forecast for unemployment came to fruition, some of those first home buyers would also lose their jobs. So it's not a great situation. And obviously we talked about this last week and I think the week before. As a policy perspective, it's terrible. You don't solve housing affordability by sucking in a whole bunch of marginal buyers in the market. Enticing them with 5% deposits. It's not the way to solve housing affordability, and you do risk pulling people in at the peak. And if we do get a correction, I think a lot of people could get hurt, obviously. And also, not even that, you don't want to suck them in just before the RBA is about to whack them with 3 rate hikes over a 12-month or 18-month period, because if they were just able to afford it when they took out the mortgage, they're going to struggle to afford it an extra $330 a month on average, going forward. And especially if, given these wage growth forecasts, whereby the Reserve Bank itself is expecting real wages to fall in the next year or so before recovering slightly, but effectively 0 real wage growth over the next several years once you average it out. So it's not a great scenario here, Catherine.
It's the forecast that I've continually given for quite a long time now, based on the land cycle that I forecast, is that we will be in recession by the time that we get to 2028. And that's based on a reoccurring pattern that happens roughly every 18 years. And it always into the peak of that cycle, rates are increased. And it's that squeeze on borrowing costs that eventually hit the margins of the market and tip it over the edge. We've seen, actually, interestingly enough, we talk a lot about the residential market, but the commercial market is particularly exposed as well. Commercial real estate making up the collateral for a lot of bank loans as well. In the US, they've had a very small bank has collapsed this year, which was exposed to commercial loans. And I would expect that we're around the time for that type of thing to start happening. But you can trace this back, because if you look back at our 3 sort of property crashes over, decades, so into the sort of peak of 1973 and the fall into 1974, the RBA cash rate increased significantly around that time. I think it got to around sort of 7.5% by 1973. Same happened into the early 1990s downturn, where we saw the cash rate substantially rise to around, I think it was 17.5%. by 1990. 2007, it was the cash rate still was quite, elevated then. It got to it was about 7.2 or 7.25% or something by March 2008. And okay, we didn't go into recession at that period, but that was due to the stimulus. Otherwise, stimulus and the bank bailout, the guarantee of the deposits in the banking sector. And we're seeing the same into this cycle. You forward wind, sort of roughly 18 years. In fact, we're exactly 18.6 years approaching that sort of cycle where we expect to see these things happening. And just as you said, the first home buyers that are being pulled in on the 5% are now going to find that they're, highly leveraged. And what would be expected right now is that the squeeze on borrowing costs is going to make people reassess their budgets when they go out shopping for properties, and we're going to see prices come down. Have you thought about what it might do to the property market? I know that Louis Christopher didn't, when he put his forecast out, and we touched on this last week, he didn't even factor in that rates might rise. How have things change over a short period of time?
Yeah, so obviously, I mean, I haven't thought too much about what's the percentage drop and blah blah blah. I'm pretty bad at that sort of thing. But the just to put it into perspective, so basically a 0.25% rise in mortgage rates implies about a 4% reduction in borrowing capacity. So if we get 3 rate hikes, that implies a 12% reduction in borrowing capacity. So obviously, if you can't borrow as much, because when I plug it into the mortgage calculators and lots of stuff, they work out how much you can afford. Obviously that's going to put, you'd think that'll put some downward pressure on house prices. But the other thing is, and this sort of goes back to my point about the first home buyers. Obviously, Australia's housing structurally has never been this expensive. So I've got some charts here from, I think I showed them last week, but yeah, the capital city dwelling price to income ratio in the September quarter was never been as high as it is now. But the important one is actually in the bottom right-hand corner. That's the percentage of income required to service a mortgage. Now, after the 3 rate cuts last year, it fell marginally to 45%. This is just medium mortgage repayments on a new mortgage versus medium household income. This is September quarter last year when Cotality they released this report, I think, in December, but it was for the September quarter last year. But even at 45%, that was still above the GFC peak when the RBA did hike. When I think mortgage rates went to about 7 point something, as you said. The problem with it is, if we get 3 rate hikes, as the markets and the RBA assumes, well, then that percentage of income to service a mortgage is going to go well above the previous peak, because we're going to give back the 3 rate cuts of last year. We're going to basically go back to the cash rate of where we were. 4.35%. But the prices are also more expensive now than they were a year ago relative to wages, etc. So we'll end up going to a new cyclical peak. And again, if you're a first home buyer in that environment, not a great situation for you. Certainly I think, and I said this last time, I think especially for markets like Brisbane and Adelaide and probably Perth as well, which is tends to be a sort of boom bust market. I think those ones are especially at risk because they've had just such massive run ups. So basically prices have virtually doubled in 5 years in those 3 markets, and that's shown in the middle chart, the middle top chart there from PropTrack. Melbourne's obviously a lot safer because it hasn't had the massive run up in values. And Melbourne's actually, as I said last time, has gotten cheaper. So the dwelling price to income ratio for Melbourne, that's the bottom middle chart there, has actually fallen. And it's the lowest out of the majors. It's fallen quite significantly, versus its peak. Whereas if you look at Perth, Adelaide, Brisbane, they've all rocketed. Sydney's always been expensive, but Sydney's still trading below its former peak. But, Perth, Adelaide, and Perth's not quite where it was in the mining boom of a decade or so ago. But, Brisbane, Adelaide are at their highest levels in history. So you think that at some point there's a higher risk we'll get some sort of mean reversion. But yeah, we'll have to see how it plays out. But again, it's those marginal first home buyers are the ones that I'd be most concerned about, just because they've gotten in, just such a very expensive level with just such small deposits. And obviously, if you take out a 5% deposit, it means you're taking out a bigger mortgage. Like you're taking out a 95% mortgage versus a traditional 80% mortgage. So that just means you got higher mortgage payments than you would otherwise, which in a in a situation of rising more interest rates is just not a great situation to be. And
It's even worse than that, though, Leith, because you can't get out of this scheme. You know what? As I've said before, all the other schemes, they were locked in. You were locked in for a year. You borrowed the first home buyer grant. You had to live there for a year. You had a stamp duty statement saving. You had to live there for a year, and then you were out of the plan. The way that they've done it this time is that you are locked in to that property until you pay down up to a 20% deposit,
yep,
because it's the government backing the lender's mortgage insurance. And if you've got falling property prices and you're left underwater, that's going to be achieving that goal is going to be even harder. So it's not like first home buyers can, convert themselves into investors, move back into the family home, do whatever they need to do they can't sell because their property prices are going backwards. We're potentially going into a recession.
yeah,
We start ramping up rates, which is the forecast. Then you're locked in. You're locked in, and you're underwater, and that couldn't be a worse. It's not only bad; it's utterly immoral to do that. With little understanding to lure people in, to lure the most vulnerable buyers, which are those ones that have never entered the market before. And I would imagine quite a young cohort. And I wouldn't believe, I would imagine that it's more than 20,000 that have taken up that policy again. And one of the main reasons I say that is because in my industry, I work in the real estate industry, I deal with buyers and sellers all the time, and a lot of other advocates and agents. And, we're coming across people that are doing the 5% all the time. Inquiry
yeah,
rate's gone up from that cohort.
yeah. And one of the problems is there's no official data on it that gets released. So under the old system, I remember there was a 5% deposit scheme previously, but it was capped. The numbers were capped.
Yeah.
There was a way more restrictions on who could take it out. There was all sorts. I think it was income caps. It was much stricter price caps to actually buy the properties.
Yeah, there
Um,
were, but there were ways around it with the income
yeah.
tax, and I can tell
Oh,
you that now because what mortgage brokers would do, as is always the case when you're dealing with the mortgage industry, there's little tricks and little quirks that they use to get around, the regulations basically. So that would be that if you had too much money in your bank account, you would move a percentage of that money out of your bank account, open a new bank account, put a small amount in, and then they
yep.
would judge the loan just using that data. Not all the money that you've got, or that would. So I mean, quite a few people sort of dropped through the net in that regard.
Yeah, but I guess my point was they used to actually release the numbers, or because they were capped, you sort of knew how many people had used it. But because it's now an uncapped scheme, they don't actually publish the numbers anymore.
Mm.
So we're sort of left. It's non-transparent. We're sort of left with industry estimates and that sort of thing. Like I tried to research how many people are actually taking it out, and all I got was just certainly not hard figures, just like industry estimates of 20,000, and I think that was up to the end of December. So obviously we're into February now, so it'd be higher than that. But yeah, we just don't really know. But you'd imagine it's pretty significant given the price bounce we got when they implemented the policy, especially at the lower end. So yeah, there'd be a lot of people out there, potentially thousands, who some of them would, I'm not saying they're all would be in trouble now, but some would be in trouble, you'd think, or
Yeah, I
facing
mean,
trouble if we get further rate hikes.
I think the risk about people that are taking up that type of deposit, particularly as first home buyers, if singles, is that you head into the apartment market, and the apartment market really is. I was reading through some of the comments that people had left under under interviews that I've done. I actually don't know whether it was our interview or it was something else that I'd done where I talked about apartment prices and how they generally go backwards. I mean, 1 and 2 bedroom apartment prices, they go nowhere. They'll either track inflation at the very, very best, but typically they go backwards because of the amount of apartment building. And I think somebody combated it and said, "Oh no, median prices for units where I am have gone up X amount." And median prices are just not representative of apartment prices at all. Firstly, because when you see a unit medium, it accounts for anything that is a subdivision, so not just 1 and 2 bedroom apartments. And the median covers a lot. You can get a new development that sells at higher prices. The median, just being the middle figure of a bunch of numbers, will go up because of that new development that has sold. But if you look at the actual individual resales of property values within any development, which I do all the time, you'll find that they generally track backwards in price. And I think that's the worry about first home buyers heading into a market on a 5% deposit, is what are you buying? Because if you're buying that type of unit, which I would imagine if they're using a 5% deposit, it's because they're on a very low budget, then that's where the danger comes. But you mentioned about some of the markets, for example, Perth. I mean, I've done a little bit of buying, in Perth for clients, and it's a red hot market
Oh yeah,
there.
it always is though. Like it's always a boom bust market. So you can see in the bottom middle chart where it got the dwelling price to income ratio. You can look at Perth. Notice how it ran up in the early 2000s. It just went through the roof with the commodity boom, and its dwelling price to income ratio is actually higher than it is now. And then it had an almighty, like it's pretty much almost a decade long correction where it fell in nominal terms by memory is about 14%, but in real terms by about 30%. And then now it's obviously surged back. So yeah, Perth's always been a very volatile boom bust market because it's so heavily linked to the commodity cycle. Um, it's very volatile and it's obviously still running. And look, to be honest with you, Perth and Brisbane could still, and I guess Adelaide as well, like they could experience another 6 to 12 months of price rise. I don't know. Mm-hmm. And maybe with the Brisbane Olympics, maybe it'll run even longer. I don't know. But it just seems increasingly risky. That's all. Whenever the price of something goes up, basically doubles in 5 or so years, that to me screams risk. But who knows? They might end up rising by, or some of them might end up rising by 130% in 6 or 7 years. We don't know, but it just seems risky. And that there are some things that are supporting those values. So they are extremely starved of stock. So the number of homes actually listed for sale in those markets, I wish I put the chart in here, is tracking well below the decade and 5-year averages. Whereas in Sydney and Melbourne, they're actually tracking above the decade and 5-year averages, which is part of the reason why their prices are lagging, especially now. So there is definitely starved of stock. I speak to people in Brisbane, for example, and they're all just saying, "Mate, there's no stock." Like it really literally is the Hunger Games in a city like that.
That's been my experience. I have a friend actually in Perth, and I was talking to her about the cycle, and she was asking me about it, and she was like, "Oh, there's no way prices can come down here. We just a friend of mine."
A decade
I
ago.
know it's always the famous last words, isn't it? I always smile when I hear people,
especially in Perth, because
yeah.
Perth. I mean, Perth's had a recent history of prices falling for years. So it's it couldn't happen here. It's like no, hang on. You're the one market which actually has had a, like in real terms, you'd say it's a house price crash. Like it had a house price crash over a decade. But the other markets haven't had a crash. They just had mini corrections here and there. But that's the one market where I'd never say, prices couldn't fall because hang on, just go back before COVID, and they were at the tail end of basically a 8 or 7. I think it was about 8 years, maybe an 8-year price decline. So it was Perth's just a boom bust market. It's just so heavily reliant on the commodity cycle. Also, migration flows, which are then linked to the commodity cycle. So, when you have a booming commodity sector, you get a lot of inward migration from the rest of Australia because they want to cash in, and then you also get net overseas migration. But when it goes the other way, well, then you usually get the flow out of there. So it just amplifies the cycle. That's all.
Yeah, absolutely. I mean, her comment was really about almost not needing to advertise properties. Is word they're selling by word of mouth, and so I definitely think that market's got another 12 months to go at least. And if we look back at what's happened previously, I mean, we saw it a little bit in 2008. The mining sector was so strong that even though it did have the initial shock when all markets were shocked, in 2008, it recovered quite quickly. Had 2 or 3 years more to go till around I think it was 2013 we saw another peak and then had its downturn, but it did that actually in the early 1970s as well. After the 1973-74 crash, Perth sort of took off quite strongly after that, and again it was on another commodity boom at that period of time, and we saw it with the OPEC oil price spike was the thing that kind of hit affordability, and terrible commercial real estate crashes through the 1970s and the 1990s. And maybe that's something we can look at
You
some.
know what? You've given me some homework. I'll try and do it for next week. So
Yeah.
basically, I've got house price data. It's from a research report. Someone did a thesis on this stuff. It's called Abelson and Chung, I think it
Mm,
was. And I've got house price data going back to basically 1972
mm.
across all the major markets. So I'm going to deflate those. So what I've done is I've spliced them with that in domain. So, you can use something else. But I'm going to go and do real house prices for each of the major capitals going back to like 1970, as far back as I can go. And we can actually we'll actually be able to see the house price corrections you're talking about.
Yeah,
Now,
that would be great.
now, some of them, if you do it with not inflation adjusted, they don't look very bad because we had 20% plus inflation through parts of the 1970s. So we had years where the house prices might have been stable for a couple of years. They didn't move, but that was because inflation was running at 20 odd percent. So there was a correction, but it was a correction in real terms, not in nominal terms. And obviously, we had some of the high inflation through the 80s as well. So just looking at the nominal values doesn't really do justice. So I'll try and deflate those by CPI and just see what happens. And
Yeah, I think the other thing to take into account with that, because I've looked at this quite closely, because obviously I study the property cycles, and not just in Australia, but sort of in the US and the UK as well. But the when I'm looking at Australia, because you can't really see clearly a cycle, we had long periods of our history where we had policies, such as rent controls and the federal land tax, and rapid population growth into sprawling areas where our property crashes were quite sort of few and far between. But that when you're looking at median data, it hides such a lot. So you can look
yep,
back to the early 1990s downturn, and it decimated Melbourne. Melbourne was hit so badly in that downturn that when I go back and I look at what commercial properties were selling for in the peak, say 1989, and then what they sold for around the low, which was around 1995. I mean, there was a halving in price on not only multi-million dollar buildings, but also real estate that was around sort of 400,000, 800,000 residential real estate. You saw it sold for that amount, and then a few years later it had a few 100,000 knocked off the price. I mean, that there was strikes in the city at that time.
I remember
The unemployment rate were soared. So it's this thing that when you look back at the chart, you think to yourself, oh, it's only, I think nationally it was a 10% drop in the median because places like Brisbane didn't suffer as such bad falls, but then they hadn't had such enormous speculation in the lead up. Whereas in this cycle, we have seen that. We did discuss that previously in the recording that you did for me, for my subscribers, about how frothy those markets are looking, Brisbane and the Gold Coast. And again, like I talk to people all the time. That I spoke to someone in the Gold Coast the other week who said to me, no, Catherine, you don't understand. There's everyone's saying that it's got plenty to go. And
yeah, yeah. And look, who knows? Like it could run. Like these things often run longer than you think, and whatever. But yeah, I just look at it from a risk perspective. I mean, anytime you get a doubling of prices in 5 or so years, that to me just, I guess, because I've always been sort of value minded. I do it, in my life. Like I'm a value hunter. I'm a bargain hunter sort of guy with everything I do. I'm basically a tightwad. Let's be honest. So yeah, whenever I see something double in price over five and a bit years, I always go, geez, that's pretty scary. But it doesn't mean it can't go further. And I'm obviously not on the ground in Brisbane. I live in Melbourne, and Melbourne's obviously gone nowhere for years. So I'm living in a market that basically isn't doing much. It hasn't for 6 years, pretty much. Observing just Brisbane from afar using data, and as you said, it's just median data, right? So it doesn't mean that certain areas which could be mega demand and have way further to run, whatever. But I'm just looking at it from a median, and if the median house price has gone up, according to prop track at least by about 100%. I think CoreLogic's got about 90%. Either way, massive, massive rises in values.
Yeah. Yeah.
So
Massive.
that to
It
me just flashes
underestimates.
red. It's just a doot,
Yeah.
doot, you know.
Yeah, yeah, yeah. I mean, you've seen it because we've had periods of time in Melbourne where, we've seen property prices just explode.
Oh yeah,
And
up
that's
to
where
like
you see,
2017. Remember?
yeah. One of the great things about Melbourne, I say great, your people listening to this might throw their hands up and despair at it because auctions aren't popular. But when you have a lot of auctions that are playing out on the street, what it does give you a chance to do is to actually see that happen.
Yeah,
You can rock down the bottom of the street and see the auction rather than waiting for the quarterly house price data to come out or trying to work out, but looking in Domain or whatever.
yeah, and it really is the madness of crowds. Well, not at the moment
Yeah.
because it's a bit subdued, but back like 2017, I think was the last time it was kind of nuts. And I remember it because
2019 as well. I mean,
yeah,
after the
yeah.
federal election, 2019, I mean,
Oh, of course, yeah, yeah, of
well,
course.
yeah.
Sorry, yeah, 2019. But even then, Melbourne, yeah, Melbourne didn't seem to run up quite as bad as the other places. But yeah, the reason why I said 2017 because I remember the houses in my area just because I live in a suburb called Ashburton in Melbourne, which
Yeah.
is it's like the worst suburb in the most expensive local government area, if that makes sense. So it's still a good suburb, but it's and it just went. I remember the prices then. I was just going, this is absolutely bonkers. And hilariously, the prices in my area are basically the same now as they were back in 2017. So they've barely moved, but they just that just sticks in my mind. And the data I remember just 2017 because I did actually go to a few auctions. I'm not an auction sort of person. I can't be bothered. I got better things to do in my time because it's not part of my job, right? But there were a few in my street, and I remember the crowds and the foreign buyers and everything. It was just madness. And I've been to, I don't know, probably 2 auctions in the last year in my area, and both of them I think were passed in. So it's just a completely different vibe.
Yeah, complete. I mean, I've had it over the years. The other market that I remember was 2007. Leading up to October of that year, where interest rates were going up, and I think borrowing rates around that time were around 9%. But the market was unbelievably hot, and we never saw a pass it. I mean, I was working as a buyer advocate for a company at that point, and every auction that we went to, it was just the prices were climbing higher than they were the previous week, and it was a remarkable thing to witness. I was working for a really the best boss that I've ever worked for in real estate. He was very astute. He didn't know anything about real estate cycles or anything like that. But the timing at that point was for a crash. Anybody that studies land cycles would have understood that that was sort of the final burst. Before the 2008 downturn, and so they would have been aware of it. But I remember it getting to the end of that year, maybe around September time, and they did another rate rise, and he came over to me and he said, this auction that we were at, he said, prepare yourself for a passing because I think that last rate rise would have done it. It would have broken the market, and it did. That property passed in. It was the first one we'd seen for well over a year. And we had to negotiate it, and then of course it wasn't much longer after that the stock market went, and the world went into the global synchronized recession, the worst recession since the Great Depression, which we will see again soon. That's my forecast. Unfortunately,
Oh,
how
I
we'll
actually,
weather it, we'll have to work it out. But
I actually agree with
yeah.
you, and not necessarily like the trigger. I think this time is going to be the AI bubble bursting
Mm.
because that just I look at that and think this is madness. You've got the major tech companies. So whether it's Meta, Microsoft, Amazon, Google, X, so Elon Musk mob, they're all, and even China, they're all in the race trying to just invest in tens of billions of dollars into these AI data centers, trying to beat each other because they want to be the one who wins. But at some point, they've got to make money on it. And I just can't see how they're making a return on this investment. I think at some point we're going to get some sort of revaluation of these companies and a lot of malinvestment and all sorts of stuff. It doesn't mean that we're not going to have AI anymore. It just means that a bit like when we had the tech wreck, at the end of it, we'll end up with something. but there's going to be a lot of carnage in the way. And I think that'll be the next trigger for the global, you know, recession or stock market crash or whatever. But again, I've got no idea when that's going to happen. That's just the risk, the big risk I see. And of course, there's always the risk of a major conflict, right? You know, China
Oh,
invades
for sure.
Taiwan or
Yeah. Well,
whatever, you know,
yeah.
but yeah.
Yeah.
So
I mean, speaking of that, Leaf, we are, because cycles is my thing, we are on that point in the cycle, which is a 80 to 84-year war cycle.
yeah, it feels like
But
it.
there's a lot of resonance in that. So, we are sort of coming up to that. There's also the Kondratiev cycle, which is it's a commodity cycle, which is where we're close to the peak of now, but toward the peak of that cycle, you'll get war as well. That's around a 54-year cycle, but we're sort of, you don't need to be Einstein to see that. We've got
Risks.
global conflict at the moment. And actually, if you talk to, I do a lot of interviews with global forecaster David Murrin, well worth anybody that's listening to this going and looking him up. He's a really good geoanalyst, but he's been, him and others that look at this a lot more closely than I do would say that we are already in World War III. And it is just a case now of, that's going to continue to escalate. And I think that's the worry about it. But
So
well, I was just going to sort of pivot from that because I wanted
yeah,
to mention the shadow banking sector,
yeah,
which in the US it is absolutely enormous. I think there's $4.5 trillion dollars of exposure to loans from institutions outside of the traditional banking sector. And because this is all opaque, you can't monitor the level of private debt because it's not held on banks' balance sheets, but because they still are the backing, they still have exposure to it. But we did see recently that BlackRock got into trouble with fraud relating to HPS. I'm reading here from a news report, but I was going to write about it this week for my subscribers. But I think it's when you see the cracks happen at this point in the cycle. When you look at those timing markers and you say, okay, there's a pattern here, there's a timing pattern, because I do believe that cycles happen in repeated and regular patterns. The greatest forecasters realize that when you start to see these things occur on the margins, you realize it's not going to take much, to bring the system undone.
yeah, and to your point about the global conflict, I think we're in a sort of phony war at the moment. So if not that any of us were around at the time, but before the Second World War, they had the phony war where it was, everything was lining up for the war, but hadn't arrived yet. So yeah, I mean, look, I sincerely hope we don't, because there's nothing more
Well,
destructive and horrible.
it's interesting because of the 100-year cycle, and this probably is quite an easy one to talk about, and it would be an easy one for anyone listening to this to go back and look at. And that is that if you look back 100 years, you will see pretty much a mirror of
Mm.
the crises that have happened, 100 years later. So you can see 1901, there was a financial crisis, 2001 there was, and then you have a look at 1907, the Knickerbocker crisis, financial crisis in the US. You'll go back to 2007, we saw exactly the same. And then the most recent mirror, of course, would be the 1918 to 1919 Spanish flu, followed by the
Yeah,
lost recession, which was a V-shaped recession that came on the back of that, because the Spanish flu did cause lockdowns that were as severe as we saw during
yeah.
COVID. And the recession really was as a result of those lockdowns
And
and
then the Roaring Twenties, and then the Great Depression.
yeah, and then because we had that mirror in the 2020. Now we're coming up to the great you know depression, which obviously had its peak in September 1929. But what people don't usually look at when they don't look at property markets of what happened 100 years ago was that the property markets peaked in 1926. They did have a second burst up after that peak and fall, but a lot of markets went around 1925. The UK industrial market went into recession because they repegged the pound to gold. But also in 1926, was when you saw the Great Florida crash. So you saw a huge Florida boom in 1925, and then coming into 1926, the speculation sort of died off. There was the Florida hurricane, and or mortgage fraud, and a lot of smaller banks went under. And we are seeing an exact mirror happen in Florida right now. Florida went through an enormous boom in population growth and property prices between 2020 and 2025. And because that now is all unwinding. So, these resonances are very strong. You have to, when you look at cycles aren't difficult to understand. It's just that the mainstream sort of seem to forget them, which is why I think that this, again, we're in the period in the run up to World War II, which was 100 years ago. So what you're saying now holds that resonance as well.
Yeah, it wasn't Mark Twain said history doesn't repeat, but it sure does rhyme. Well, there
Yeah,
you go.
yeah, that's right. Yes, what else have you got to show us?
Yeah, so obviously another thing is we've got this big push at the moment for capital gains tax to be reformed. So there's been this broad alliance stretching from the usual think tanks, the left ones or the whatever, some of the more right wing think tanks, the New South Wales Treasury, a whole almost a broad church has come out saying that we need to reform the capital gains tax discount on the grounds of housing affordability and budget sustainability and all this other stuff. Now, my view on it is, yeah, we should reform it, but I don't think it's a panacea for the housing market, and the reason for that is shown pretty clearly in the chart on the right. That's from The Economist, where they basically put so in Australia, there's often the capital gains tax discount when the Howard government introduced it back in 1999. They often blame that because Australian house prices surged thereafter. And often blame, because it's a correlation thing, right? It was introduced, house prices boomed, therefore capital gains tax is one of the reasons why Australia's housing market has boomed and so expensive. But actually, globally, you can see pretty clear in that chart, global house prices in real terms boomed as well. So I don't think the capital gains tax discount is the reason for it. Otherwise, because Canada and all these other places that are similar to Australia also had massive house price booms. I think it's more global financial deregulation and the Basel II capital rule changes. So that have been the bigger reason for the surge in house prices. But anyway, whatever. But that doesn't mean it's not worth doing, right? So we've got a chart there in the top left that's from Treasury showing that the capital gains tax discount overwhelmingly benefits the top 10% of income earners. That's that makes sense. But the bigger one, so I guess from a budget sustainability perspective and for an intergenerational equity perspective, it makes sense to change it. The middle chart there, and this data is about a year old because unfortunately the ABA has changed its mortgage statistics, and it's a lot harder to get this sort of data now. But basically, you can see a almost perfect or very strong inverse correlation between investor demand and first home buyer demand. So when the share of investors goes up, the share of owner occupiers goes down because they compete for the same stock, right? So the investors are winning, first home buyers are usually losing. And so if you make it marginally harder for investors or less enticing to enter the housing market, you're going to help first home buyers and you're going to, by definition, improve the home ownership rate. So it's worth it on those grounds. And it would put some, moderate downward pressure on house prices or at least stop them rising as quickly. So I think it's definitely a worthwhile thing. It's costly for the budget. It crowds out first home buyers. So it ends up with higher investor participation, less first home buyer participation. And it also, worsens inequality because it benefits the wealthiest people, lowers the home ownership rate. Worth doing. My issue with it is the suggestions that are being put forward is to basically halve the discount from 50% to 25%. I think that's ridiculous, quite frankly. I think they should just go back to the pre-1999 model. So before they brought this in, the way it used to work was only real capital gains were taxed. So it means if you held a property for 10 years, any asset, I should say, for 10 years, and it doubled in value, which would be an incredible capital gain, but let's just use that as an example because it's easy. So your asset goes up 100%. If inflation was 30% over that 10-year period, you got taxed on 70%. So you pay your marginal tax rate on 70% of the gain. That, to me, was a good system. And it should never have been changed, and we should go back to um, the way the 50% discount works is there's no more inflation indexing. So what it basically means is that if you hold an asset for more than a year, if you sell it, whatever profit you make, you only pay half of it off as tax on your personal income tax. Now that distorts investment for short term. It's like short term investment because you can basically buy an asset if it goes up in value in a short period of time and you hold it for just over a year, you can flip it and you haven't had that inflation erosion in the asset base, and you make you only pay capital gains on half the gain. Now the problem with the 50% capital gains tax discount is there's a sort of flip over point whereby the old system was more generous than the current system. And that's if you hold the asset for a long period of time. So if you hold it for say 12 years, given the inflation we've had, you're actually worse off under the 50% discount than you are under the old system. And if we reduce the discount to 25%, it means that basically if you hold an asset for more than 5 or 6 years, given the inflation that we've got, you're actually worse off. And I think a better system is just to go back to the pre-1999 version and just tax real gains. That would encourage longer term investment over shorter term investment. Because if you only held an asset for just over a year, well, you're going to pay the full amount of capital gains pretty much because you've got very little inflation in that time. But if you hold an asset for 20 years, well, you'll get a bigger discount because you've held it for 20 years and inflation's gone up so much over that period. But I think, on fairness grounds, and it just makes sense to basically tax real capital gains. So gains after inflation. And that was the pre-1999 version. I think that we should just go back to that. Like just go back to the future. It should never have been changed, and let's just go back to that system rather than just applying a blunt discount, which doesn't take into consideration inflation and penalizes you the longer you hold the asset, which is kind of stupid because you want long-term investment, right? You don't want people, flipping houses and all this sort of stuff and just constantly in and out of the housing market. I'm using housing as an example, but you don't want that with shares or anything. You want people to invest for longer term than shorter term, generally speaking. It provides more stability. If you're talking about housing investors here, you don't want them chopping and changing because that creates disruption in the rental market, right? You'd rather someone buy a house, hold it for 15 years and have a renter in there for the whole 15-year period. That's just more stability than having 5 owners in that time where tenants get kicked out, the home's on the market, selling in the market, which means you don't have a tenant in it for 3 months or whatever it is, and all of this disruption. It's just, you don't want the chopping and changing. And I think our capital gains tax rules should reflect that. And the best way to reflect that is just go back to the pre-1999 system where only after inflation gains are taxed at your marginal tax rate. I think that's the way to go.
Yeah, I mean, I wonder how popular this discussion will be for the current government, because they'll have burnt fingers from what they remember leading into the 2019 federal election, where it was widely blamed. I don't know whether it was truthful or not.
I don't think they'll care though, Catherine, because the political environment's so changed now. We've got basically one party state now. Unfortunately, it's like Victoria. So we've got a one party state because the coalition have been totally decimated. They've, part of their votes gone to the Teals, part of their votes gone to One Nation. The Conservative side of politics is basically having its vote carved up. We've got the Teals stealing the woke conservative side, if I can say that. Not even really conservative, but the more progressive woke side that used to vote for the coalition. So yeah, Labor doesn't have to worry about not being in power, and they could basically do whatever they want, I think, at the moment. And the Greens obviously support this, so to get rammed straight through Parliament without a problem. But I just think if you're going to do it, I mean, preferably you do it as part of a broader tax reform package, right? Like Australia's tax system is broken. It needs to be totally changed to make it more efficient and equitable and all that sort of stuff, and to stop taxing workers so bloody hard and start moving it to other areas.
Yeah.
But
I mean, that was what the Henry tax review, came out to do. I mean, that was a fantastic tax review that was done under the Rudd government that came out and basically said,
got ignored.
Simplify it, move it off of productivity, move it,
on the land resources.
That's
and
right, land
consumption.
pay. Yeah, that's right. It sort of it was. I don't know how much was spent on it. Ken Henry did it.
Yeah.
I made huge use of it at the time because it has such a brilliant chapter on land taxation and
Yeah, it was good. It's good on a lot of things. Good on superannuation. Good on heaps of stuff. So I
you
mean, the
you
whole thing
can't
is,
even get it now. It's not even if you go and look for it on the website. I think it's. I've got a link to some archive version of it, but
yeah, you got to get it
I mean,
somewhere.
what a
But yeah,
waste of money, though. What a
oh,
complete and utter waste of money because nothing was done from it. It's the same with any Senate inquiry or any financial
yeah,
inquiry that's done. I mean, the outcome of it, unfortunately, is negligible. You know,
yeah. And well, I mean, if you look at it, how many housing affordability inquiries we had in the last 25 years?
well,
Probably
we've had
40.
heaps. Yeah. I mean, and then we
Yeah,
had the around that time actually was when the Supply Council were doing their
yeah,
thing on rental affordability, and that Rudd sort of came in with all these ideas of what he was going to do. I tell you, when this government will tip over is if we do have a bad recession.
yeah.
That would kick them out. That would change. People would.
Yeah. Well,
Uh,
I mean, they
Traditionally, that's what
certainly
happens.
they're certainly not popular, right? They're only in by default because, a bit like in Victoria, right? We've got a terrible state government here. We've had, they've been, but the government we've got here has been in power for like 22 of the last 26 years or something. It's insane.
Yeah.
And the state's gone down the toilet. Well, let's be honest. It's an absolute rebel.
Yeah.
But unfortunately, yeah. And in Victoria, the Victorian government is the only government in Australia that is still here after the pandemic. So everyone else turned over their governments after the pandemic. And Victoria, who actually locked down the hardest, had, what was it, 9 months of lockdown, was miserable, had the worst outcomes health wise, had the longest lockdowns, had the biggest state debt.
And a criminal, we should
Yeah,
say,
yeah,
alleged criminal
yeah,
running.
all that stuff, but they're still in power. And,
Yes,
and so,
it's unbelievable. Yeah, I mean, it's truly depressing living because I don't speak to many people but yeah, it's unbelievable that it's ended like that. But I think what's also interesting about Victoria on the housing front is that well, I mean, I see a lot of this. I've actually got a client at the moment who's paranoid about it, but it's the rezoning because Jacinta's idea was to make Melbourne the townhouse capital of Australia. So she's rezoned swathes of land. They haven't captured the uplift from that rezoning, so that's one big problem with it. But it's over and above councils and over above neighbourhood disputes that we are going to get. We've got these activity zones where they're going to build predominantly high-rise, cheap accommodation, which, as we know, is not really where the demand is. I think that's what is the problem with apartments is that there are a huge amount of them that are empty. The vacancy rates in apartments is higher than anywhere else. The demographic that live in apartments is quite tiny. So I think when I looked at when I did some analysis of ABS data, the people that live in apartments are predominantly renters. I think it peaks around the age of 27 and then drops off, and then only 14% of 27-year-olds actually live in apartments. So in other words, it's where you start off, it's not where you finish.
yep,
Our biggest buying demographic in Australia are families with kids. That's our biggest demographic altogether. So they're the ones, or families thinking about having kids, couples thinking about having kids, and that's the type of housing that it really is in demand, which is this subdivision and building heaps of apartments is not popular at all. And then we've got the rail loop that's being built, and a lot of controversy over that because not only of a sinkhole, I think, was exposed recently. Did you see that
yeah.
in the media? I mean, I know people have sort of said, "Oh, well,
Melbourne's toast.
yeah," but I mean, it's the people that live over the areas where they're actually digging that are reporting the vibrations in their homes.
Yeah,
Um,
or I'm sure some of their foundations are slipping a bit, which causes
yeah,
problems as well. So, well, I mean, look, let's be honest here. So, the reason why we've got to build all these shoebox apartments is because the official population forecast for Melbourne is 9.2 million people by 2065, 66. Now, that's a 3.7 million increase in where we are now. So, I think I mentioned this a few weeks ago, but Melbourne at the turn of the century was 3.5 million people. And it took us 165 years to get there. And then yet by 2065, 66, after we've already added about 2 million since the turn of the century. So it's like a nearly 60% increase. Insane. But in just 65 years, Melbourne's expected to have added, what's that, like 5.5 million people, 5.7 million people, according to their forecast. Well, obviously, if you're going to grow that aggressively, you got to be squeezing them into shoebox apartments. There's just no other way around it. And Australia never learns, because between 2015 and 2020, when we had that massive high-rise apartment boom across Sydney and Melbourne and other places, the quality was terrible. We
Yeah.
had the flammable cladding crisis. We had the Opal and Mascot Towers in Sydney, and there's similar ones in Melbourne. They were just really poorly built. And the reason why, yes, it did put downward pressure on rents for a bit, but, you know, do we want to repeat that? Like, you don't, the fact of the matter is, if we keep growing the population so aggressively, you're going to have to cut quality in order to house them, because you just got to build so much stuff so quickly. It's going to be very poor quality. And
But
that seems to be the approach.
there's a huge amount of building activity in the Docklands, build to rent,
Yep.
huge numbers of build to rent that are going up in Melbourne. But I can tell you, I have inspected a lot of apartment buildings, and there's not been one that I've inspected of the newer ones that have been built, which hasn't had significant issues. So whether the cladding is an issue, anybody out there who's watching this that's thinking about buying, you really need to check the vendor statements, the minutes, the owners corporation minutes, to have a look at that, because the bank will degrade you. The bank will want to know if there's cladding issues before they lend,
Yep.
particularly if you're borrowing on a 5% deposit. But you'll also notice when you go around these apartments that a lot of the windows leak, and there's a lot of
Yeah.
pooling water on the balconies,
And
and
this is the
water
future.
damage, of course, is your concrete cancer, and that is uh, devastating for these buildings.
And the strata freeze are
Yeah.
through the roof. Like Four Corners has done, reports on the strata fees that they charge on these things.
Yeah,
It's insane.
it's unbelievable. The admin actually, for they'll get you at every corner. I mean, the admin, that the owners corporations uh, that manage the buildings charge is, if you don't get someone who's really savvy on this overseeing it within the apartment building, then you're being robbed.
Yeah.
Yeah, so I mean, there's all these problems with it, which is why when we're building scores and scores of apartment buildings, you've got to be so careful with it, and it's tragic, really, that is happening. And the build to rent, of course, it's almost like this. I used to think about it a bit like the World Economic Forum when they brought out that controversial advert over COVID, that you shall own
Rent and be happy.
and be happy. It is this idea that you don't really need to own anything. You can rent for life, and you can be happy, and you can just live in this sort of shared economy where you don't need to need to own everything. And that is kind of like, you see elements of that sort of creeping in. But yeah, it's a little bit worrying. It's a little bit worrying.
Yeah. It's just stupid, because we saw the problems in the, 2015 to 2020 period when we did all this stuff. And the solution is just to double down and do it even harder.
Mm.
And we're doing it purely to keep up with this insane level of population growth that's projected. Like, as I said last time, it's over 13 million people in 40 years. That's the equivalent of adding Sydney, Melbourne, and Perth to the population in just 40 years. And if you're going to add a Sydney, Melbourne, and Perth, and mind you, 80% of that's going to be in the capital cities. So
Mm.
if you're going to add a Sydney, Melbourne, Perth, with most of that in the capital cities, well, you're going to need a Sydney, Melbourne, Perth worth of homes, infrastructure, water, energy, schools, hospitals. We just can't build this stuff quick enough. And we've seen it. We can't build it quick enough, because we've seen what's happened in the last 20 years when we've run this policy. So instead of maybe thinking about, hang on, maybe this didn't work too well in the last 20 years, maybe we should reverse track and not do this. The government solution is always to go double down and do it harder. And as a result, we sort of have we're going to have these dystopian outcomes of just people living in high-rise, poor quality shoeboxes. A lot of them renting, but even if you buy, you're stuck, with this garbage and with a much lower quality of life. And I just think it's just ridiculous how this country has decided to sell out its own citizens.
Mm. Yeah, I mean, the perhaps the one thing to watch around that is what might happen if we did suffer a bad recession. And because Melbourne's property prices haven't gone up to extremes, I don't know whether we would see it so much in Melbourne or see Melbourne hit so badly. But in the early 1990s recession in Melbourne, where Melbourne really was decimated, I mean, there was a population exodus
Yeah.
at that time, which just exacerbated it. And population growth, as we discussed last week, and we'll touch on it again next week, I think. But it's such a population growth that suddenly moves into areas where supply cannot available supply. It's not the amount of supply that's built over time, it's the amount of available supply right now, right then, to absorb the population that's moving into those regions. It can't accommodate that, and that's why you get rent rises, and then that feeds into price rises as well. But the exodus on the other side of that just exacerbates any downturn. So I would wonder what you would, what we'd see happening in real bubble places like the Gold Coast, like Brisbane, that has run up quite far in price. But you see this happening across, I mean, one of the reasons across the globe, we've spoken about Canada, we've spoken about New Zealand. Both of those are losing on population, and that is impacting rents and impacting property prices because demand is leaving the markets. And that's also what I was talking about earlier that's going on in certainly the bellwether state in the US, which is Florida, is that the population is moving out of that area. They're losing on population now, so losing on demand, and they've built too much.
Yeah. And I mean, Australia, one thing Australia's got going, well, not really going for it. Even if Australia had a recession, it still would be a hell of a lot better place to live than, say, Mumbai or Delhi or something, because most of the biggest migrant source now is from India, right? So there is 1.4 billion people in India. Australia could always turn the migration tap on even harder, no matter what. We shouldn't do it, but the government could do it, and they already sort of have done it, because that's where we get the by far the biggest source now. So I unless the government directly changes the policy, I can't see us ever having a population decline. You could get like what's happened in Sydney and Melbourne over the pandemic, and Sydney's been happening for years. You could have Australians or residents moving, say, to Queensland or other places.
Yeah.
But they're always just getting way more backfilled by people coming from overseas. So, like Sydney's experienced strong population growth as well, even though it's had negative net internal migration. So a lot of Sydney siders have left. They've been leaving for the last decade or so, or decades really, because the housing's so expensive. But it just gets like they are a drop in the ocean compared to the numbers that come from overseas. And so this is a government policy induced rental crisis and housing shortage. It is wholly government induced by running excessive immigration above what we can possibly provide to these people. I mean, if you import hundreds of thousands of people every year into the capital cities, and the forecast for the next 40 years is 200,000 migration per year into the capital cities, plus another 40,000 into the regions roughly. So if we're going to keep doing that, well, then you're going to have a structural housing shortage, because we never accommodate that. And that's just the long and short of it, unfortunately.
Yeah, I mean, it's definitely been a trend actually since COVID, thinking about it, just as you're talking, with the number of people that have spoken to me about their desire to move into regional areas and to get out of the cities and to move into areas that are more affordable, when they're from Melbourne or Sydney. I mean, it happens in Sydney a lot. You'll see people looking at, other areas like Newcastle, and, not wanting to be necessarily stuck in the city if they're not, if they can work, further away. But yeah, it'd be interesting to see what happens. Well, we've actually gone over an hour, so I'm gonna wind it up, because otherwise we'll talk about everything, and that'll be
we just talk about next week anyway.
So we'll finish it there, but we will reconvene next week. And what any data coming out that you're keeping an eye on this week?
I'll have to take that on notice. I actually didn't bother checking the forward calendar. I just forgot. So anyway, we'll cover that next week. Next week, I want to cover a topic on what this population surge means for the regions.
Yeah.
So I've got some great data on that. And also, potentially if I can get around to it, I want to do those real house price charts going back to the 1970s, just because I think that'd be interesting.
That would be really interesting. Definitely interested in.
I've just got to pull some data.
Yes. Well, that's your job for this week in your in the amount of time that you have when you're not working, when you're shopping on Amazon or whatever you do. Done.
Yeah, I don't do much of that.
No, I know. Okay. All right. Well, we will chat soon.
All right, no worries. Speak to you next time.